I'm about to sell a rental property and I still owe $400,000 to the bank. Surely that debt reduces my taxable profit, right? No, your mortgage balance does not matter for capital gains tax, and there is a simple formula that explains why. Your mortgage balance, whether it's $400,000 or your house is completely paid off, is irrelevant to the tax you owe. I'm going to show you the simple formula the IRS uses and why trying to account for your debt would actually be unfair. Let's start with the formula for calculating your taxable gain. So here is the formula. It's your purchase price plus improvements minus depreciation, and that equals your adjusted cost basis. The most important number to figure gain on is that adjusted cost basis. Once we have this number, we plug it into our gain calculation formula, which is as follows. We take our sales price minus the adjusted cost basis minus selling expenses, and that equals our taxable gain. As you can see, the mortgage amount isn't in there. Let's dig deeper with an example. Chris versus Christina. So meet Chris and Christina. They each buy a rental property for $200,000 and spend $100,000 on improvements. They rent for 9 years and both take $95,000 in depreciation. The key difference? Chris took out a $150,000 loan to purchase the property. Christina paid cash. They both sell their properties for $500,000. The gain calculation is identical for both. We start with the purchase price, which was $200,000, then we add improvements, which is $100,000, and then we subtract depreciation of $95,000. This gives them each an adjusted cost basis of $205,000. Their taxable gain is calculated as $500,000 minus the $205,000 cost basis minus, let's say, $15,000 in selling expenses. They both end up with a $280,000 taxable gain. If we allowed Chris to deduct his $150,000 mortgage, it would be wildly unfair to Christina. She shouldn't be penalized for paying cash. The tax code is correctly designed to be neutral to your financing decision. Now, this doesn't mean the IRS is anti-debt. We need to talk about the annual tax benefit Chris did receive by having a mortgage. He was able to deduct his annual mortgage interest against his rental income, which means he had less taxable income every year for 9 years. Let's dive a little deeper and discuss home improvements. We've established that the adjusted cost basis is the main ingredient. Let's zoom in on the most confusing part of that formula. Improvements. What counts as an improvement? The IRS is very strict here. There's a huge difference between a repair and a capital improvement. Repairs are maintenance to keep the property running, like fixing a leaky faucet or patching a hole in the wall. You deduct the full cost in the year you pay it. These do not get added to your cost basis. Improvements are costs that materially add value, extend the life of your asset, or adapt the property to a new use, such as replacing the entire roof, installing a new HVAC system, or adding a deck. These must be capitalized and added to your cost basis. Now, make sure you are correctly tracking capital improvements because they are the only thing that reduces your ultimate taxable gain when you sell. Moving on to discuss the depreciation recapture tax. This is a really painful part. We use the $95,000 in depreciation to lower our taxes every year. But when we sell, that money comes back to haunt us. This is called depreciation recapture. When you sell your property, the gain equal to all the depreciation you claimed or should have claimed is taxed at a special federal rate, currently up to 25%. That's right. It's separate from your regular long-term capital gains rate. Your total $280,000 gain we discussed is broken into two buckets. The portion taxed at up to 25%, the depreciation, and the remaining gain taxed at the lower capital gains rate. You can't escape the tax on depreciation. You just get to delay it. So there's one final step, which is deducting sales expenses. Let's focus on this last piece of the gain formula, the sales expense. This is the one place every seller misses a legitimate deduction that reduces the taxable gain dollar for dollar. Be sure to deduct all of these items from your sales price. Broker commission, title insurance, and attorney's fees associated with the closing costs, transfer taxes, and necessary inspection fees paid by the seller. You are only taxed on the net amount you walk away with. Make sure your tax professional includes every closing cost there is to reduce your tax bill. Hey, my name is Arash. I help people create plans to pay less in taxes. Did you know if you like, subscribe, and comment on my videos, you will automatically save 10% in taxes? Okay, that's actually not true. Also, I need to let you know that none of this video should be taken as tax advice. However, I would love to give you individualized tax advice. All you have to do is schedule a consultation on my website, link below.